Did you know that if you purchase your property in Canada and sell it within the first year, you will be subject to an anti-flipping tax? And for this video, we're going to break down some examples that I saw in a recent article which talks about how a buyer purchased two properties and then tried to sell both of them during the first year and ended up spending even more than they were expecting. And if you did have any questions on these rules or the Toronto real estate market, click on that first link in the description down below or scan the QR code to book a call at any time that works for you. So this article was on the Globe and Mail, and it says the residential property flipping rules that can catch you unaware. This probably is supposed to just be unaware, and this is by Tim Chesnick on May 21st. It does go on to say here that confusion can cost you money. Thinking about a federal residential property flipping rules that came into effect on January 1st, 2023, and they are still very much in effect today. And in fact, in BC, they even made it another tax on a property that you sell within the first 2 years of ownership. And this says that this may catch you by surprise with confusing rules. And he goes on to say that one of his friends bought two condos in late 2023, found it tough to rent them at amounts he needed to break even. So he sold one for a profit of $75,000 6 months after acquiring the place, and the other sold 9 months after his purchase for a loss of $50,000 when the market for condos took a turn for the worst. The problem was that his friend Jackson's transactions were caught under the residential property flipping rules. And those rules go on to say that if you sell a residential property within the first 365 days of owning it, any profit will be taxed as business income. You have no ability to call the profit a capital gain. And the difference being is that capital gain is taxed differently than business income. For business income, for example, whatever you make in business just gets taxed at the end of the year, straight up in the tax percentages. Whereas a capital gain gets taxed very differently. And the old math used to be half of half. So if you make, for example, 75,000, half of that is around, give or take, 35,000, which gets taxed. And that's just kind of that general rule. But now it would get taxed as $75,000 business income, which is a very different tax category. There are a few exemptions which make the disposition place due to death, marriage breakdown, additions to family, disability, insolvency, certain job relocations, involuntary termination of employment, and threats to personal safety or expropriation. Now, this is one of the things that all of these could help get back your tax. However, from my knowledge and what I've been figuring out is that your tax is still payable and then you have to file to get that reimbursed later on. Definitely something to speak to an accountant about, but in any of the research I've been doing, that's how it seems to be applicable. Same thing with that new BC tax as well, as it's still payable up front on the closing, and then you have to try to get the money back from the government, which, as we all know, could take quite a bit of time to get that reimbursement back. Now, here's where the caveat comes into play, is that on the property that person made a profit of $75,000, that tax becomes business income. But on the loss of $50,000, instead of being taxed as capital loss, it will now just be void of tax, which means that there is no write-off for the capital gain or capital loss. The loss of the flip property is deemed to be zero, so we can't apply the $50,000 loss against the $75,000 profit. Ouch, definitely an ouch there. As an aside, he wants to argue that these properties fall outside the definition of a flip property, saying that they were inventory of a business he was carrying on. I know it sounds confusing, and it is. And this also talks about how there are situations in which property flipping rules could apply to an unsuspecting owner. And let's take a quick look at these three. So transfer to a spouse. If you transfer residential property to your spouse and elect for that transfer to take place at fair market value, which allows you to avoid the attribution of income of the property back to you later. These become very confusing. I definitely recommend getting professional advice on any of these. Transfers to a corporation. So if you were to transfer it from your personal to a corporation, that could play a factor on no capital gains. However, there would most likely be land transfer tax on some of these. So definitely need to get professional opinions there. And trust distributions, also something that people would have to get more details on. And you can go through this article on Globe and Mail to get more details. There's also dispositions after death and dispositions by an alter ego trust. Again, as mentioned, if you live in British Columbia, there are also provincial property flipping rules, which could treat some scenarios differently. It's all a little bit confusing, and I'd love to hear your thoughts in the comments down below on what you think of these anti-flipping rules now that the market has definitely subsided compared to where things were when all these rules came into play because everybody was making a fortune on flipping these properties. I'm Michael Ouzas. Thanks for watching.